Hi, I'm Kristen King from the Investing Channel, and welcome to IP Go, the show where we take a look at the IPO world, past, present, and future. In last week's show, we looked at the latest direct listing to hit the markets, that of ZipRecruiter, which debuted on the NYSE on May 26th with a reference price of $18. In direct listings to date, the listing companies haven't raised new money. Instead, their shares have effectively been introduced to the exchange and then commenced trading. ZipRecruiter executives and their advisors may now be wondering if they should have tapped the markets. Such has been the warm reception that the stock has received. The shares opened at $20 and have gone on to trade as high as $23.05, with more than 16 million changing hands in their first session. I think we can call that a job well done. This week, we're looking at three separate IPOs from very different sectors, but which have one thing in common, which is that they are seeking a premium valuation or rating, which in the current market may not be easily achieved. Donut maker Krispy Kreme has published its IPO prospectus. The company is returning to the markets after 5 years of private ownership. Revenues for the quarter ending April 4th jumped to $322 million, up from $261 million a year earlier. That's an impressive growth rate of 20% plus. However, not everyone is happy with a $4 billion valuation that Krispy Kreme is seeking. After all, owners JAB bought the business for just $1.4 billion in 2016. The new valuation would put Krispy Kreme on an equal footing with Starbucks, whilst rival Dunkin' brands, which was taken over last year, enjoyed far higher profit margins than Krispy Kreme currently has. The roadshow for the deal will need to convince investors that Krispy Kreme is worth a premium rating. A sector that's no stranger to highly rated companies is that of payments and fintech. The latest business in the payments space to signal its intention to float is Marqeta, which is aiming for a valuation of $12 billion. Marqeta, based in Oakland, California, was founded in 2010 and provides card issuing and payment processing solutions that facilitate digital banking and lending. Its systems and software can be accessed via an API and customized by the end user to suit their individual business needs. Last year, Marqeta raised $410 million in two back-to-back funding rounds that were supported by leading venture cap investors. That fundraising valued the group at $4.3 billion, so it's quite a leap to the $12 billion figure that Marqeta is aiming for as a listed entity. Marqeta is aiming to sell 45.4 million new shares at between $20 and $24 each, and will raise just over $1 billion in new money if it can achieve the top end of that range. Marqeta can boast a roster of fast-growing clients such as Uber, DoorDash Inc., and Klarna, and it offers some unique and capital-efficient services such as just-in-time funding. Deal managers Goldman Sachs and JP Morgan will need to convince investors that the prospects for the business justify an $8 billion valuation leap. Marqeta will list on NASDAQ under the ticker MQ. Israeli software company Monday.com is offering 3.7 million shares in a price range between $125 and $140 in an IPO which will value the company at $6.12 billion. Monday.com will list on the NASDAQ under the ticker MNDY. Once again, JP Morgan and Goldman Sachs are coordinating the deal. Monday.com's products allow a business to build bespoke systems to manage their workflow on a single platform, encompassing areas such as marketing and CRM, project management, design and creativity, and HR and operations. Existing customers include Adobe, Coca-Cola, L'Oreal, and Hulu, and the business generated revenues of $161 million in 2020, though it made a loss for the year of $152 million. What's more, both losses and revenues were up sharply compared to those seen in 2019. Monday.com's debut will show just how much IPO investors want to chase a loss-making business, and much will depend on Monday.com's management demonstrating to investors that break-even, if not profitability for the business, will not be too far away. That's all we have time for today, but as usual, make sure you do your due diligence before making any investment decisions.